Um, since we're going through two quarterly reports, I told Jason basically just to give up and not give a whole lot of economic commentary. Bill Blackwell could only be here for 60 minutes, so I want to finish everything that was voting on during that time. So anyway, we'll get it done.
Ready if there's a specific page that he wants the site to look up, we can bring it up on screen.
Yeah, he's only going to go through about 4 or 5 pages most. Give some overall economic commentary. I'm going to just ask people if they have questions specific to the reports, and we'll go from there. This in the right order. Okay. How are you doing, Eric? Surviving?
I'm surviving, yeah. I'm actually pretty mellow, so I can't complain. It's always quiet before the storm.
Trouble with Zoom, so I'm going to be calling in on this one.
Not long ago.
That is so funny because I wondered the exact same thing. I'm like, oh, we can't get together and have dinner.
Mark, I'm craving, I haven't been there in a while, but I'm craving Sunday.
We're live now.
Okay, great. Okay, we're calling the July 27th Investment Advisory Committee meeting to order. Let's go through the roll call first. So, Bill Blackwell.
I'm here.
Art Carter. I think he's still trying to log in. I know Al Sondag is not here. He told me he wouldn't be. Kathy Ward.
Here?
Okay, and from city staff we have Eric Sun and Courtney Bellucci. Okay, first on the agenda then is the approval of the minutes for the January 27th meeting. Does anyone have any changes to those minutes? I know I do. On item number 3, which was the approve the second quarterly investment report. It is, I believe it's the second sentence. I'm sorry, the third sentence where it says Al Sondag brought up the need for Nissan stock due to headline risk it carries. It should be something in the order of Al Sondag brought up the issue of holding Nissan asset-backed securities. So change need for to issue of, and change stock to asset-backed securities, and you could put in parentheses ABS. Okay, any other changes to the minutes? Okay, you need a motion to approve as corrected. Bill, you're on mute.
All right, I'll make a motion to approve them as corrected.
Okay, do I have a second? Kathy, even though you weren't here, you can second that motion.
Oh, I can. So I will second that.
Okay, all in favor?
Aye.
Aye. Any opposed? Okay,
Mark,
so
I would have to abstain, would I not?
I was told even if you weren't here for that meeting that you could still approve the motion to approve the minutes.
Okay. All right. Then I will vote yes.
Okay. So moved by a vote of 3-0. Okay. Next up is we've got 2 investment reports to go over. Jason Schmidt is here from Chandler, and I've asked Jason to abbreviate his presentation. We'll go through the third quarterly report. That's the third quarter fiscal year ending March 31st. So, Jason, are you with us?
I'm here.
Okay, great. So, Jason's going to skip the economic commentary for the March 31st report, and he'll go over a number of appropriate pages in the report. So Kathy and Bill or Eric, if you have any questions about that report, you could raise them after Jason goes over them or as he's going over them, and then we'll switch gears to the June 30th report. Okay, Jason, it's all yours.
All right. Now, do I need to share my screen, or how should we do this?
I can share the screen. You just need to tell me what pages to show.
Okay, perfect.
Can you see it?
I can see that.
All right. I'm on page 3, so just let me know where to go.
All right. So I'm going to go all the way up to page 9. And on page 9, I'm just going to go over what the what the characteristics look like for the consolidated portfolio as of March 31st. And so the average maturity of the portfolio is 1.61. The duration was 1.44. The purchase yield was 1.95%. The market yield was 0.85. It was a AA plus rated portfolio and was about $147 million at the end of March 31st.
Okay.
I'm going to go to page 12.
You know, Jason, could you just comment a little bit, just for anyone who's listening, just the drastic reduction in the average market yield over from 12/31 to 3/31?
Sure. So the reason that happened is during the month of March, as we saw the probably late February through the month of March, basically because of the pandemic, we had the Federal Reserve come in and essentially slash rates to zero over that period of time, the second time in my career that they've done that. And then in addition to that, they started a lot of what they call asset purchases. And so what you saw there was they started to also purchase Treasury and agency securities, and also made plans to purchase other securities. So with that in mind, what happened is overall yields in the portfolio dropped because of that action, and you'll see that also when we go over the 630 report.
Okay, thank you.
Then on page 12, and then what you can see here is just the allocations just in general. And so what you can see here, I'm just going to give you the highlights. So in the table above, you have the different sectors. Then you have the market value from March 31st, and that's really compared to the market value of December 31st. And then there's the yield to maturity on March 31st and the effective duration. The big changes that you saw as far as the overall asset allocation is there's a little bit less than there was in December in U.S. Treasury securities, and there's a little bit more in U.S. agency securities. Agency securities are definitely providing a little bit more value than they have in the past. We saw credit spreads really have widened out because of the pandemic, and not only just in corporate securities, but we've also seen that in agency securities also.
Okay, great.
And then I'm just going to move up here to the total return page, which is on page 19. And then I'm going to just look at the numbers, and this is all as of March 31st. And so, you know, the graph above, the dark green line is the 3-month return, the gray line is the 12-month return, and the light green line is since inception return. And what you can see, really, even though we've had a lot of volatility in the financial markets, especially towards the end of March, if you look at the Citi's portfolio, as far as the Chandler managed portfolio, that had a return over the last 3 months as of March 31st, 2.49, over the last 12 months, 5.26, and since inception, 1.80. And also, what you can see is that the Treasury agency benchmark, which is the table, the fourth line down there, you can see that its return was 2.78. The 12-month return 5.39, and since inception 1.66. There was really a flight to quality over that period of time. This benchmark is made up of, you know, over 95% of it is actually Treasury securities at this point, and really you saw those securities perform better when you look at a benchmark that has corporates and government securities, which is more akin to the Citi's portfolio. Over the last 3 months, that was up 2.22, 12 months 4.97, and then 1.73. So in general, even as you saw the stock market really sell off, because the Citi's portfolio is in high quality securities, its investment policy is written for that. The portfolio is doing exactly what it's supposed to be doing at this period of time. It's retaining its value, can provide liquidity if needed, and is a very liquid portfolio.
So, yeah.
And then just
Good.
moving to page 20, here you can see that on a net of fees basis, just the Chandler portfolio. So you can see that was 2.47, 12 months 5.17, and 1.72, since inception number.
Okay. Good.
And then the final page I'm going to talk about on this report is really looking at where yields are at today. This is the yield comparison page. And so at the end of March, you can see you can earn 6 basis points on a 3-month bill. On a 6-month bill, 14 basis points. At that period of time, LAIF was 1.74. I'm going to show you in the June 30 what the yield was, but right now LAIF is around 0.85%. Here you can see commercial paper 1.55. You can see the money market fund, a government money market fund at 22 basis points. And then you can see the portfolio yield for the San Clemente portfolio, which is 1.95%. So you can see kind of that drastic change. And also you can see that 1.95% on the purchase yield. That's because you purchased longer term securities over that period of time. From a purchase yield perspective, your portfolio is retaining that earnings power that it has by purchasing those longer term securities.
Okay. Good.
And that's it, really.
Okay. Yeah, I mean, I think the only thing I would add is we had a couple securities called during that quarter. Yeah, roughly, or not roughly, but $2 million worth of securities, and that's on the transaction ledger. But I'm going to. I think that's all we're going to go over for March 31st, unless the committee has specific questions that either Jason or myself can answer regarding that time period.
Hey, Jason, I just have sort of a quick question in terms of, having extended our portfolio's duration and starting to use the longer duration portfolio. That's obviously benefited us quite a bit here in this decline in rates. Do you have any ability to quantify roughly how much it's benefited us?
We do. So if you think about it, if our portfolio I'm going to turn to page 19, and this is just as of March 31st. So if you think about it, the portfolio would have probably performed pretty close to being the in line between the 1 to 3 year AAA to single A, which over that last 3 months was about 2.22%, where the portfolio managed by Chandler actually was almost 2.5% or 2.49%. So you're looking at approximately 27 basis points over that 3-month period. And then if you took it over a longer period of time, let's just say that's 1 year, you're looking at something that's more akin to about 13 basis points, something like that. So it was definitely, although I don't think any of us had thought that rates would come down to the levels that they are today when we decided to make that change, it was definitely something that has been very beneficial for the portfolio.
We got lucky.
Exactly.
Yeah, good question, Bill. Thank you. Okay, if there aren't any other questions, I need a motion to accept the March 31st investments quarterly investment report as presented.
So Mark, this is okay, and I'll second that.
Okay, all in favor?
Aye.
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 Is anyone opposed? Okay, so moved. All right, well, let's move on then, Jason, to the June 30th.
All right.
All right, which page do you want to start on?
I am going to start actually on page 3. And in the interest of time, I'm not going to go over every economic slide that is in the presentation. What I am going to give you is just a summary of where we're at today, our viewpoints on some of the things that are happening today, and where we possibly could be moving towards in the future, although my crystal ball, like everybody else's, especially with regard to the virus and the spread of the virus and how it's going to morph itself and change over time, is cloudy, in the sense that I don't think anybody really has a huge or a big grasp that can tell us exactly what's going to happen. And so the economic data remains weak. That's what we've been seeing as far as looking at the results or the impact of the pandemic and the social distancing measures and things that have been taking place in order to curb the tide of the spread of the virus. When we look at GDP for the first quarter, it was down around 5%. Remember, that's an annualized number. And so when we look at quarter two GDP, which we're going to get our first look in a couple of days here, we're probably going to see likely between 20 to 30% down. But remember, that's an annualized number. When you look for all of 2020, we're looking to be down, let's call it between 5 and 10%, something like that is what the current forecasts are. And those forecasts really show or are really counting on a pretty dramatic increase as we move throughout the rest of the year as far as overall economic activity. And so we'll see kind of how that really goes from here. Unemployment is probably the biggest issue today. And so when you look at how many people are unemployed, what the unemployment rate is, and also looking at initial jobless claims for unemployment insurance, along with continuing claims for unemployment insurance, we're talking about, millions upon millions of people that are unemployed, and an unemployment rate that is at least 12, 13%, something like that, and in some cases could be higher than that, depending upon what measurements that you're really using today. With that, not only the Federal Reserve, as we talked about before, and all of its different programs as far as different lending programs, of which some we've never seen before, and then there are also some that we saw back in 08, 09. They're basically saying that they'll buy Treasury and agency securities in amounts in order to support the economy, and at this point it looks like it's going to be unlimited. Also, they're buying corporate bonds. They're also have lending facilities for Main Street and also municipalities at this point. And so definitely a large amount of stimulus from the Federal Reserve. We think that's going to remain intact for a long period of time. And also we don't think that they'll raise interest rates for a long period of time. So we could be at this level of interest rates, this lower level of interest rates, as far as on the Fed side of the equation, for a period of time. And along with that, the federal government, through the CARES Act and also other types of things that it's passed, has about $2.7 trillion worth of stimulus that has been either committed or actually been put into the economy at this point. This is through unemployment benefits, increased unemployment benefits. This is also for lending, also giving money through the CARES Act to different types of entities. And so we've seen a large stimulus package also from the federal government. Those things two together have really kind of helped stem the tide of actually the fall in the economy. But still, we're going to be left with a lot of damage here, in the sense that we have a huge amount of unemployment that's in place today. Also, some businesses may not open up after this, and we're also seeing where we have separate closures here in California and also other states that are going on where we reopened or having to close up again, which again puts stress on overall businesses. So the outlook is very murky at this point. We do expect from our firm that you're going to see the recovery continue. There's lots of letters that people are putting on the recovery. Some are calling it a W shape, some are calling it a V shape, some are calling it a U shape. We really don't have a viewpoint on that. We just think that it's going to be with us for a long time, the overall damage of that, and we're probably going to see at best maybe high single digits unemployment, maybe even potentially double digit unemployment in the teens by the time we get to the end of the year in December. And so we continue to monitor the economy as far as how that's related to the overall holdings of the city's portfolio. I showed you before, especially the government holdings have improved, i.e. that the market values of the increased as rates have fallen. In the start of the crisis, corporate securities, we had credit spreads widen out, meaning that prices of those securities were not doing as well as government securities. But since then, the Federal Reserve has started to buy corporate securities. It's also helped to support those markets. And since then, especially in the names and the issuers that we're buying, as far as from a spread basis, some are very near, if not below that, of the pre-COVID levels. And so you're really seeing that as far as the overall performance of the portfolio. We continue to see the two-year yield curve is the yield curve is relatively unchanged just in general from March to June, and we expect that you're not going to see a ton of movement, but of course we still have other issues that are taking place. The federal government is spending a lot of money. We're thinking that the Federal Reserve's balance sheet will probably be north of $10 trillion by the time we're through with this, and then the deficit is really ballooning at this point. The U.S. Treasury still has over $1 trillion worth of treasuries that it needs to issue during this period of time. Also, although not a big issue right now, there are some concerns over inflation in the future. In the sense that we really started to see some of the monetary measures increase, and so we're definitely watching that also at the same time. And the result of that would probably be a steepening of the yield curve, where the Fed would actually leave rates relatively unchanged on the Fed fund side, but investors would demand more compensation for that potential in inflation in the future. But that is probably at least 6-12 months down the road. It's not something that's a near-term concern at this time. And with that, I'll open it up for any questions that you may have on the economy.
Well, yeah, I mean, you kind of just addressed one of my questions, which was the inflation and obviously the impact it has on interest rates. So from Chandler's viewpoint, I mean, 6 to 12 months isn't that far away. So does that cause you to invest in shorter-term securities with the idea that you can roll over those securities into higher yielding instruments 12 months from now, or what are Chandler's thoughts on that?
Our thoughts right now is we just don't have enough data to really say what the picture is going to be looking like, more than 6 months down the road. I think right now, for the foreseeable future, let's just call that 6 months at this point, as far as the interest rate picture, it's likely to be somewhat more status quo in the sense that maybe some minor movements across the yield curve. Also, the Federal Reserve is talking about yield curve controls, where it would actually go out and try to control certain parts of the yield curve. It does some of that now through quantitative easing, but that would actually be something that's a little bit different. It would explicitly state that it wants, for instance, the 3-year Treasury note to be at 20 basis points or something like that. We do think that inflation, there's definitely a heightened concern about that, but we do think it's at least 12 months down the road. And so from our perspective, given that the average maturity of the portfolio that we manage on behalf of San Clemente is around 2 years, basically 50% of the portfolio matures off over that 12-month period. So right. with that in mind, we're not too concerned at this point, given where we're at today.
Okay, good. Thank you.
Hey, Jason, I just have a quick question. In terms of, say, on the vaccine, the most optimistic outcome is we could have something by maybe the end of the year, and that I realize that's subject to a lot of different variations. But say that we get a vaccine by the end of the year. Have you guys kind of thought about, or what are your thoughts on what happens with the economy and interest rates in the event that we do get a vaccine that's pretty effective by the end of the year? And I realize that's a stretch, but.
Right. So I'm going to couch as there's so much uncertainty, so I'll couch that with my remarks just in general as far as what would happen. We have thought about it, though, and not just a vaccine, but some sort of drug cocktail that also takes some of the minimizes deaths, minimizes your sense that you would have to go in the hospital even if you caught the virus. We still think that we're so far away from that, meaning that we're at least 6 months away from that, where you would have a vaccine where they'd be given to the general populace here in the United States and also abroad at the same time, that we think the damage has really been done to the overall economy. And we think that right now, as far as what the vaccine would mean for interest rates, yes, you'd probably see a little bit of a pickup in interest rates, because I think you'd see a pretty probably dramatic pickup in growth at that period of time. It might take 3 or 6 months to get that going. But there are so many people unemployed today that may not have jobs. And the other piece that really we fear more so than anything else is the amount of deficits that we're racking up on a longer term basis. This is where we're focused more than anything else. We do think that there will be some sort of scientific solution to the coronavirus, to the COVID-19 virus. What we're really focused on now is what does it mean like 18 months from today? Meaning that our likelihood is maybe 6 months we'll get some sort of scientific improvement to the overall COVID issue. And then after that, what's it going to take for the economy to really pick up after that? And if we think about it, things aren't going to ramp up overnight. We're seeing some of the ramp up take place right now, and it's been kind of a haphazard event in the sense that we saw a pretty good ramp up that happened as we opened up. Let's just call it in that June timeframe. But now here in California and also Florida and Texas, other states, we're starting to see that close up. And so we do think that you would get some certainty that would be around that, but also you have to have an economic growth that's already taken place. And right now we think that that's really pretty much constrained today. And you can see that through the Fed's measures and things like that, where they think this is going to take a long period of time in order to really resolve the overall issue.
Okay, thank you. So why don't you then go ahead and continue on for your and let us know which pages of the report you're going to cover.
Sure, I'm going to move on to page 9 and cover some of the same pages that we did on the overall portfolio.
Okay.
So on page 9, what you can see here, this is looking at June 30 now. And so we have an average maturity of 1.52, and a duration of 1.35, a purchase yield of 1.75. You can see that's come down from that 1.95 level. As we're reinvesting, as you have some of the LAIF pools and things like that their rates are starting to come down, you're seeing that affect the overall purchase yield. You can see the market yield is 0.52. If you look back on March 31st, that was 0.85. And so a lot of that is A, treasuries coming down even from that March level, but B, it's the credit spreads really tightening up. And so really that's helping to improve that. It's a AA plus portfolio, and the portfolio is $156.2 million. And then I'm going to move forward to page 12. So here you can see a little bit more as far as what's going on with the overall portfolios as far as the different sectors. And so you can see the sectors are on that far left-hand side there. Then you have the market value as of June 30, the market value as of March 31st, and you can see where the changes are towards the end of the table. And so you can see there's a little bit less in U.S. Treasury securities, agency securities. There's a little bit more. Agency securities are providing more value to the portfolio. You can see the commercial paper has matured off of the portfolio, and then also you can see the money market funds also coming down from about $4.3 million to $1.7 million. And so continue to keep the portfolio, invested, fully invested, and in addition to that, looking for the opportunities that are out there while maintaining the overall primary tenets of the investment policy, which is safety, liquidity, and then finally yield. Then I'm going to move forward here and look at the total returns of the portfolio, and that's on page 19. And so here what you can see on page 19, again, on the table above or the graph above, you can see the 3-month is the dark green, the gray is the 12-month, and then the light green is the since inception number. And then looking at the table below, this is all as of 6/30. So over the last 3 months, the portfolio earned 80 basis points. Over the last 12 months, 4.63, and then since inception, 1.86. You can see the internally managed 0.32, 2.52, and 1.21. Remember, the internally managed portfolio has more liquidity just in general for that. And then you can see the consolidated 0.58, 3.65, and then 1.54. If you look at the Chandler managed portfolio, which has a longer duration and has that more consistent duration because it's not necessarily worried about day-to-day liquidity, you can see that it beat the Treasury agency, which was 0.14 versus 0.05 and 1.62, and it also beat the AAA to single A U.S. corporate government index, which was 0.69 over the last 12 months, 4.17, and you can see since inception, that's 1.77%. Bill, you had asked before what that change that was made, what's the benefit of that has been. And you can see, just over that 3-month period that we had since March 31st, you can see that benefit, especially on a 12-month basis, has even increased further, as you saw credit spreads tighten up too at the same time. And so you can see that was a very timely change that the committee undertook. And then you can see on page 20, here you can see on a consolidated basis and net of fee. So you can see 0.78, 4.55, and then since inception 1.77. And you can see the benchmarks are the same because they don't have a fee that's part of them.
Great.
And then on page 21, you can see just the yield comparison there. And so you can see that yields on Treasury bills came up a little bit over that 3-month period. So you can see the 3-month bill, which was at 6 basis points in March, is now 13 basis points. The 6-month bill is 13 basis points. You can see LAIF came down to 1.15% at the end of June. The most recent reading, I think, is from the 22nd, and I think it's either 85 or 86 basis points at this time. You say commercial paper.
So that let me just pause right there because the city keeps a lot of money in LAIF. So, back in the end of March, it was 1.74. End of June, it's 1.15, and currently 0.86. So almost, coming up on 100 basis points in just 4.5 months. So pretty dramatic.
Yep, and then you can see commercial paper, that really came down. Credit spreads were pretty wide on commercial paper for a while there. That really came down. You can see governments came down to 0.1, and then you can see the purchase yield to maturity on the city's portfolio is still 1.75%. Yes, it came down around 20 basis points, but still definitely not at those low levels that you can see government securities, and also did not decline as much as LAIF because of those longer term securities.
Great.
And then just going to move on to page 23. On a consolidated basis, the portfolio fully complies with the investment policy and California Government Code.
Okay.
And then just on page 25, you can see just the issuers on page 25. And you can see that the majority of the portfolio is in government securities. And then where you have corporate securities and things like that, you can see the percentages are very low there, less than 2%, and in many cases less than 1%.
Right. And I mean, since even though Al isn't here for this meeting, since he raised the question last time in January about Nissan, the asset-backed security, to update us, Chandler still feels fine about that. I know it's AAA. It's not there. It's the portfolio of assets as opposed to the Nissan's credit rating as a corporation. But if you could just make a quick comment on that.
Sure. If you turn to page 27, you can see the security. It's under the ABS. It's the last security that's on there, and that's the Nissan Auto Trust. One thing to just show you here on 630, just putting kind of the money where the mouth is kind of thing, is that you can see the gain loss there is around $16,000, and so the trust continues to perform very, very well. All asset-backed trusts that you own, not just the Nissan, have very, very small, any kind of, defaults or anything like that of the loans are definitely in line with what the expectations are for the trust. And the trust remains in very, very stable footing. And you can see that by the price of these securities. None of these securities has fallen below par. In fact, most of them are trading above par at this point in view. So if you were to see, if the market was anticipating that you would see substantial losses from these securities, definitely they would discount those, and you are definitely seeing very high quality assets such as the asset-backed securities, including Nissan, trade above par.
Great, thank you.
Mm-hmm. And then I'm going to move all the way down here. Mark, did you want me to go over just the Chandler managed portfolio on page 39?
Sure, yeah. Anything that you want to point out there would be fine.
Sure. So I'm going to just turn to page 40. And this is the Chandler managed portfolio. So it's the portfolio that doesn't necessarily have the liquidity needs and is managed more towards the strategy. And so you can see here the average maturity is 2.24. The average duration is 2.12. You can see the purchase yield is 2%, down from about 2.1%. You can see the market yield, 31 basis points. So the portfolio is at a net gain because your book value is above that of your market yield. It's a highly rated portfolio. It's a AA plus rated portfolio, and the portfolio is $81.6 million, almost 81.7. And on page 41, you can see kind of what we've done in the portfolio. And so basically what we've done here is we've allowed the commercial paper to mature off. We've also taken some of the treasuries and we've moved those into the agency category. We think that agencies on a relative basis now, looking at the risk reward, are a good value right now in the marketplace.
Yeah.
And then on page 45, you can see that the Chandler portfolio, like the consolidated portfolio, fully complies with the investment policy and California government code.
Okay, great. Okay, any questions from the committee on Jason's presentation, or also specifically the internally managed portfolio?
Mark.
Yeah.
It's Art.
Hey, Art.
So could we have a little bit of discussion regarding the supranationals? There have been a couple articles in the Wall Street Journal about how developing nations are seeing situations where they probably are going to default.
Okay, Jason, do you want to address that since Chandler's holding the supranationals?
Yes. So let me get one thing real quick. So let's go back to page, and let's look at what we hold first. Let's go back to page 32.
It's not a lot, Jason.
Yeah, it's pretty small. It's around 2.3, almost $2.4 million in par. I would just say that yes, there is some big issues with some developing countries and things like that, as far as kind of their debt and things like that. As far as the overall supranationals that are owned by the city, first of all, we own some pretty short paper here. It's probably 1 to 2 years. Second is they have a very well diversified loan book. And although there are some nations that are going to have problems just like everybody else, just like any other kind of bank and things like that, they hold a very diversified book. As far as looking at market prices for these securities continue to trade at least pari passu, and a lot of times even through U.S. agency securities, especially on a new issue basis. And so from that standpoint, I think that the credit quality, yes, just like every other type of entity, they're going to come under some stress, but I don't think that we will see actual defaults of these agencies, because remember that underlying those agencies is a consortium of nations that support those organizations.
Yeah, but the consortium is facing stress as well. So I guess in a worst case scenario, these just get pushed out.
The securities or the loans that underlie that? Because I think there's two different things.
Right.
One, I think that you would probably see at those institutions, what they would do is they would work, just like they would work with a homeowner here in the United States, under some kind of forbearance, that they would renegotiate those terms of those loans and push those out. With these securities, because they're actual securities of those actual agencies, you would not see these pushed out. You would see these mature at their maturity dates. It would have to take a very, very large turn for the worst. And I think if you saw that take a turn for the worst, there are other things that are also going to be happening in the overall economy.
Hey, Jason, have the rating agencies had any comments about the supranationals? To my knowledge, they haven't even put them on negative outlook, much less negative watch or anything. Have they done anything at all?
No, they have not. And actually, on an S&P scale, they're rated above the United States government.
Right. And they're still rated above the U.S. government. Is that correct?
Correct. They're AAA rated across the board, and probably one of the few entities that's out there where you can get a AAA rating from Moody's, S&P, and Fitch.
Right, and to put it in perspective too, they represent 1.57% of the portfolio and currently are showing an $88,000 gain. But yeah, I mean, I think that's a good question, Art, because yeah, I think we're all reading that in the newspapers, and I think it's important how Jason pointed out that what happens to those countries isn't necessarily what's going to happen to those securities. So. Good. Any other questions from the committee?
This is Councilmember Ward. I don't have any questions, but I thank Jason for his report. I really was looking forward to hearing what your outlook was. And what I'm hearing is this is going to take some time.
I think time is a good way to put it. And I think it's also, I would say one other item, there's just so much uncertainty today. Relative to what we've had to kind of forecast in the past with.
Yeah. Okay, so if there are no further questions, I need a motion to accept the fourth quarter investment report as presented.
This is Councilmember Ward. I'll move that.
Okay, do you have a second?
I'll second it then.
Okay, Bill. All in favor?
Aye.
Aye.
Is anyone opposed? Okay, so moved then. Okay, Jason, I want to thank you for, as usual, a great presentation and the information that you provide the committee. At this point, we're gonna shift gears and finish off the meeting with the broker-dealer evaluations. So I don't want to keep you on longer than we need to, but again, thanks very much, and look forward to hearing from you, if not before, during our October meeting.
Great. And it's great to see everybody's happy and healthy faces too. Nice to see that.
Okay.
All right.
Thanks, Jason.
See you guys. Have a good one.
Okay. Thanks. Okay, so the only other thing we have on the agenda are the broker-dealer evaluations, and we could actually make that singular as evaluation. We still haven't received a broker-dealer questionnaire from Wells Fargo, so I think since Art Carter left, they are just mad at us. That's my only explanation. But let's see, Courtney sent out the broker-dealer questionnaire response from Raymond James, and I was wondering if the committee had any questions about that questionnaire response.
Mark, do you know Rosa?
Yes.
Oh, very good. Okay.
I mean, I know her professionally. The city's been using her for, gosh, forever. My time, as city treasurer, about 7 years, I've used her more and more. So
She's been there since 2012. So.
Right. Yeah. Yeah. She's been a very good resource. I used to use Bill, but he came onto the committee, so we can't use him anymore to buy security. So
we use him in a different way.
That's right. He's more valuable to me this way, but so anyway, I do need to get a second broker-dealer, and Wells Fargo's playing hard to get, so I'll probably look for another one, but I at least want the committee to ask any questions or voice concerns about Raymond James, if there are any. Okay. So if there aren't any, I need a motion to accept Raymond James as an approved broker-dealer.
So moved.
Okay, do I have a second?
I can go ahead and second that.
Okay, thank you, Bill. All in favor?
Aye.
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 Okay. And any opposed? Very good. Motion passes 4-0. That's it. Courtney is, I don't know if any of the public are viewing the live streaming, but if they are there any ways for them to ask a question, or are there any questions out there?
There is a way for them to ask, and I didn't receive anything.
Okay.
I don't see any comments at this time.
Okay. Well, I guess the Investment Advisory Committee just isn't as exciting as the City Council meeting. Right, Kathy?
Yes. And we don't want our investments to be too exciting. We like to keep everything conservative and save our money.
Right. That's the way we do it. Okay, so our next meeting will be October 26th.
Mm-hmm.
And I wonder if we'll be meeting in person and breaking bread together, but if not, we'll be meeting on Zoom, I'm sure. So I need a motion to adjourn this meeting of July 27th to October 26th.
Do we know what time that meeting's at?
5:30.
5:30. Okay, I think I heard a motion.
Okay.
Yeah, so moved.
I'll second that.
Okay,
I'll
Kathy,
second
thank
that.
you. All in favor?
Aye.
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 Okay, the motion is carried 4-0, and we are adjourned. Thank you very much, committee. See you soon.
Thank you, everyone.
Okay,
Thank
and
you,
thanks Courtney and Eric for
Yeah.
running this meeting very much.
Yeah, thank you, Courtney. Sorry.
Sorry for my tardiness.
It's okay.
Yeah, me
Okay.
too.
You'll be meted out your punishment next time.
I understand.
All right, thank you, Mark.
I understand. All
Worries,
right.
have a good night.
Okay,
Bye.
thanks. Bye-bye.